Hello and good day, good morning, everyone. Today we will discuss about be able to prepare a budget. So basically, this is our learning outcomes for finance and accounting, and our topic is how to prepare a budget. So we will explore the fundamentals of budget preparation. Budget play a vital role in finance and accounting, helping organizations plan uh, and control their financial activities. By the end of this lecture, I believe that you will have a good understanding of how to prepare a budget. Just bear in your mind that a budget is a financial plan that outcomes the expected income and expenses uh, over a specific period. It serves as a roadmap for organization to allocate resources efficiently and achieve their financial goals. Budgets can be created for various timeframes, such as monthly, quarterly, or annually. So let's start from here. Indicative contents, budgets, operating budget, cash budget, fixed budget, master budgets, incremental budget, activity-based budget, budgeting based on value proposition, zero-based budgeting. Everybody can hear me and can see my screen. If any issue, please do let me know. So as I said, budget play a vital role in planning, controlling, and evaluating the financial activities of business. So budgets are essential financial tools that help organization plan, control, and evaluate their operations. By understanding the various types of budgets available, including the operating budget, cash budget, fixed budget, master budget, incremental budget, activity-based budget, budgeting based on value proposition, and zero-based budgeting. So what is a budget? Anybody can tell me what is a budget? Okay. In simple term, a budget is a financial plan that help us estimate and keep track of our income and expenses over a specific period of time. It acts as a roadmap of our money, guiding us towards our financial goals. Whether we are individuals or organizations, by creating a budget, we can prioritize your expenses, or you can prioritize your expenses and make sure you are not spending more money than you have. So how to create a budget? The first step is to determine your income, which includes your salary, wages, or any other sources of money you receive regularly. So next, list all your expenses such as rent, mortgage payment, utility bills, groceries, transportation cost, loan payment, and any other regular expenses you have. Be sure you include saving as an expense tool, because it is important to set money aside for the futures. In personal context, here here we will start with personal budgets. When we as he said, a budget typically include categories such as income, salary, investment, fixed expenses such as rent, mortgage repayments, mortgage payments, utilities, variable expenses, groceries, entertainment, saving, and debts payments. By creating a budget, individuals can identify areas where they may be overspending or have room to save and make adjustments accordingly. So basically, we look at different categories of our income and expenses. So first we consider our income sources such as our salary or any investment. Then we look at our expenses like rent or mortgage or any other bills. So there are things we have to pay regularly and they usually don't change much. Next, we have variable expenses. These are costs that can vary from month to month, like groceries or entertainment expenses. We also include saving in our budget. Setting aside some money for saving is important because it helps us build an emergency funds or save for our future goals, or some people save money for holidays. Next one is for organization budgets. Organization budgets are more comprehensive and involve various departments and activities. Operational expenses are also considered, which include costs like employee salaries, office rent, and supplies. Capital expenditures are another important aspect of organizational budget. These are the investment organizations make in things like equipment, technology, or infrastructures to support their operations. Marketing expenses are also included to promote the organization products or services. A well-designed budget helps organizations plan for growth, make strategic decisions, and ensure financial stability. By having a clear understanding of their income and expenses, organizations can allocate resources wisely and identify areas where they need to cut costs or invest more. So next one is purpose of budgeting. So here we will discuss the key reasons why budgeting is important for company's success or even in our personal life. So first and foremost, budgeting helps with the planning. First one is planning. So by going through the budgeting process, business are forced to look into the future. Then control, budgeting adds in control. Actual results are compared against the budget, allowing management to take appropriate actions. This helps in monitoring and managing expenses, revenues, and overall financial performance. So another purpose of budgeting is communication. The budget serve as a formal communication channel, enabling both junior and senior staff members to converse effectively. It ensures that everyone in the organization is aware of the financial goals, constraints, and expectations. Budgeting also facilitates coordination. It allows for the coordination of all parts of the business towards a common corporate goal. By having a unified budget, different departments can work together in a proper manner, ensuring their activities. Furthermore, budget play a significant role in evaluation responsibility. Accounting divides the organizations into budget centers, each with a manager who is responsible for its performance. Motivation is another important purpose of budgeting. Budget can serve as a target for managers to aim for. When managers operate within or under the budget level of expenditures, they can be rewarded. Additionally, here is motivation. Motivation is another important purpose of budget. The budget can serve as a target for managers to aim for when manager operates within or under the budgeted level of expenditure by can be rewarded. As I said, then authorizations, budgets can act as a formal method of authorization for a manager. It authorizes them to incur expenditures, hire staff, and pursue plans that are included in the budget. Last one is delegation. Budgeting involves delegation and management involvement. Managers may be involved in setting the budget, which gives them extra responsibility and motivation. Next one is methods of budget. So method of budget, different kind of budget methods, fixed and flexible, increment, zero-based, rolling budget, activity-based budgets. So I will quickly define all of these methods of budget. Fixed budgets and flexible budgets methods involve estimating income and expenses based on fixed amounts. Increment budget is method where the budget for a new period is based on the previous budgets with incremental changes. Then it comes to zero-based budget. Zero-based budget basically requires us to start from scratch, just like hitting the reset button. In the method, we examine each expenses item and expense item and justify its necessary. Then is rolling budgets. A rolling budget is a method where the budget continuously updates throughout the year. It usually covers a specific period such as 12 months, and as each month passes, a new month is added to the end of the budget. Next and last one is activity budgeting. Activity-based budgeting links budgeting to the activities or operations of an organization. It involves identifying activities, estimating their cost, and allocating resources accordingly. Now, differentiate between different types of budget. So we will discuss the different types of budgets commonly used to financial planning for businesses. Budgeting plays an important role in helping organization, as I said, and also effectively plan their spending and allocate resources. By understanding the various types of budget available, business can better align their goals and objectives. Any questions so far? Okay. The three main types of budget we discuss now and are the operating budget, cash flow budget, and financial budget. The operating budget focuses on day-to-day operations, while the cash flow budget tracks the organization's cash inflow and outflow. And the last one, the financial budget, provides an overview of the business financial health, including cash flow projections and the balance sheet. Master budget. Here we are discuss the three important concepts. The world of budgeting and explore three important concepts: master budget, static budget, and flexible budgets. So what is the master budget? A master budget brings together all the lower level budget within an organization, such as sale, production, marketing, and administrative budgets. Then we look at static budget. Next, we have the static budget. Imagine you have a fixed level of output or sale for your business. A static budget is prepared based on the fixed level, regardless of actual business activity level. So, flexible budget. Unlike the static budget, the flexible budget adjusts based on the actual level of activity or output. It is designed to provide a more accurate benchmark for comparing actual costs against budgeted costs. Number 9 is, next one is capital expenditure budget. The capital expenditure budget and the zero based budget. Capital expenditure budget outline the spending for large scale projects or investments such as new equipment, technology, or facilities. Next one is zero based budget. Zero based budget is every department function is reviewed comprehensively and all expenditures must be justified for each new period. It starts from a zero base and every function within an organization is analyzed for its needs and cost. Both type of budget serves different purposes and provide unique insight into business finances. The choice between them depends on the specific needs and circumstances of the business. If a company planning significant investment is new equipment, technology, facilities, capital expenditure, budget would be the appropriate choice. Expenditure budget would be the appropriate. It helps the organization allocate funds for these large scale projects and ensure that the necessary capital is available. On the other hand, if a company wants to thoroughly review and analyze its expenditures, prioritize resources, and eliminate unnecessary costs, then the zero-based budget is the way to go. This budgeting approach allows for a fresh starts and encourages detailed assessments of every functions within the organization. Here a different table of different types of budget. Operating budget cover daily expenditure for costing revenue and expenditures. Then cash flow budget project cash inflow and outflow to ensure sufficient liquidity. Financial budget includes projections for cash flow, balance sheet to provide financial health overview. Then master budget, comprehensive budget, including all lower level budgets, providing a broad business overview. Prepared for a fixed static budget, prepared for a fixed level of output or sale unchanged regardless of actual business activity. Then is a flexible budget adjusts based on actual level of business activity or output, provides an accurate benchmark for comparison. Then a capital expenditure budget outlines spending for large scale investments such as facilities or equipment. Then is a zero-based budget. Every expenditure department function is reviewed. All expenditures must be justified for each new period. Any questions so far regarding types of budget or difference between, if you want to ask any further difference between budget is? Okay. Now we will prepare different types of budgets. So in general, preparing different types of budget involves gathering historical data, estimating future costs and revenue, and making strategic decisions about where to allocate resources. So for different type, discussing different types of budget, we will use Lucy Boutique as a business. So Lucy Boutique's budgeting plays an important role in managing finance and making informed decisions about resources allocated. So let's get started. Budget involves Budget involves three key steps: gathering historical data, estimating future costs and revenue, and making strategic decisions about resource allocation. So let's, budget is and about informed decisions about resources allocation. So we will discuss the concept of operating budgets and explore how they are prepared. So to prepare an operational budget, you will typically project your revenue, estimate how much you expect to earn in a sale. So operating budget helps businesses project their revenues, cost, and overall profitability. It allows them to plan and make informed decisions to achieve their financial goals. In this, we will follow, as I said, Lucy's business owner as she prepare her operating budget. So let's get started here. Projection revenue. Lucy's first step is estimate her expected sale based on past sale data and upcoming trends. So for the next quarter, she forecast her revenue to what is it? It's 50,000 pound. So then projection cost of goods sold here. If Lucy sells products, she needs to estimate the cost involved in making or buying those products. For Lucy, the estimated cost of goods sales for the next quarter are 20,000 pound. So next one is calculating gross margin. To determine the gross margin, Lucy subtracts the cost of goods sold from the projected revenue. In this case, Lucy gross margin would be 50,000 pound minus 20,000, which is equal to 30,000 pound. Then operating expenses. She needs to estimate her operating expenses, which includes costs like rent, utilities, salaries, marketing, and office supplies. So for the next quarter, she expected, expects her operating expenses to be 15,000 pound. So calculating operating profit, the final step is calculate the operating profit, which is by subtracting the operational expenses from the gross margin. In Lucy case, the operating profit would be 30,000 pound minus 15,000 pound is equal to 15,000 pound. So cash flow budget. So now we will talk about cash flow budget. To prepare a cash flow budget, and this budget helps individuals and businesses forecast and manages their cash flows and outflows. So by understanding and controlling your cash flow, you can make informed decisions to ensure financial stability and success. Projection cash flow. The first step in preparing cash flow budget is to project your cash inflows. So this can include various sources such as sales, revenue, loan funds, or investments returns. So for an example, we will focus on Lucy's situations. So Lucy's expected cash inflows. Lucy's anticipates receiving 55K in cash inflows. These funds may come from her sale, revenue, loans, or other investments. So projection cash outflows. The second step involves projecting your cash outflow, which pass all your cash expenses, like inventory, purchase, operating expenses, loan repayment. So she expects her outflows to total 45,000 pounds. So these expenses may arise from, as I said, purchasing inventory for her business, covering her operating expenses, making loan payments, or any other financial obligations she has. So net cash flow 55,000 by subtracting Lucy's cash outflow 45,000 pounds from her cash inflow 55,000. So we find that her net cash flow amount to 10,000. So a positive net cash flow indicates that Lucy is expected to have a surplus of 10,000 pounds, meaning she will have more cash coming in than going out. Capital expenditure budget. To prepare a capital expenditure budget, you will typically identify capital projects, determine what large investments you plan to make, like buy equipment or property, estimate cost for each project, estimate all the associated costs, prioritize projects. If resources are limited, decide which projects are most important to complete first. So identifying capital projects. The first step is creating a capital expenditure budget is to identify the capital projects that require significant investments. So in Lucy case, she has decided to refurbish her boutique. This refurbishment project qualifies as a capital project since it involves a substantial investment. So estimate cost uh, associated with the capital project. In this case, we need to determine the expenses involved in hiring a contractor and purchasing the required materials for the refurbishment. So Lucy has estimated the total cost of 10,000 pounds. So project cost of refurbishment contractor material is 10,000 pounds. So in summary, Lucy's capital expenditure budget for her boutique refurbishment is 10,000 pounds of project priority, high priority due to being the only capital project. So she will spend up to 10,000 pounds. So now master budget. Master budget. Here we will discuss about master budget. Any question about up to here capital expenditure budget or anything? Okay, so master budget. We will discuss the concept of master budget and how it helps is in planning and managing our company's finances. A master budget is an essential tool that brings together various budgets to provide a comprehensive overview of a company's financial position. To prepare a master budget, we typically follow a step-by-step process. So let's go through each step using the example of, Lucy, who will be combine her budget for her business. So summarize Lucy's example, to summarize Lucy's example, her master budget would include the follow operating budget, 50,000 pound cost of goods, 20,000 pound gross margin, 30,000 pound operating profit, 15,000 operating profit, 15,000 pound. Then add her cash flow budget, cash flow of 55,000 pound, cash outflow will be 45,000 pound, net cash flow of 10,000 pound. And including her capital expenditures, we just seen about boutique refurbishment of 10,000 pounds. So prepare budget, income statement and balance sheet. Now zero-based budget. the concept of zero-based budget and explore how it can help businesses. Any question about master-based budget? Okay. So now we will discuss the concept of zero-based budgeting and explore how it can help business like Lucy's make informed financial decisions. Zero-based budgeting is an approach where every cost is carefully evaluated and justified based on its contribution to the company's goal. Zero-based budgeting is a powerful approach that ensures every cost is scrutinized, justified, and allocated based on its contribution to the company's objectives. By following the 3 steps, identifying costs categories, justifying each cost, and allocating resources, businesses like Lucy's can make informed financial decisions and optimize their budgetary planning. Through this approach, companies can streamline their expenses, prioritize investments, and work towards achieving their long-term goals. Fixed and flexible budgeting. Fixed budget is a budget prepared at a single level of activity. So, in other words, it is based on a predetermined level of activity or production. This type of budget assumes that the activity level will remain constant throughout the budget period. For example, if a company plans to produce 1,000 units for a product, the fixed budget will be prepared based on the specific level of productions. So now flexible budget is a budget prepared with the cost behavior of all cost elements, known and classified as either fixed or variable. The budget may be prepared at a number of activity levels and can be fixed or changed to the actual level of activity for budgetary control purpose. With a fixed budget, the company would prepare a budget based on a specific production level. But with the flexible budget, the budget takes, into accounts the actual level of activity and adjust the budgeted amount accordingly. It would increase the budgeted various cost or reflect the higher production level. Now, example, a company has the following budgets and actual information for a department. So level of activity, unit of output. So level of output, 1,000 units, budget cost is 20,000, budget actual information, level of output 1,200 units, and cost is 23,000 pounds. So here we will analyze the situation using the given data. So assuming all costs are variable, has the companies done better or worse than expected? So we have to answer these questions. So we need to compare the budget cost with the actual cost. The budgeted cost were 20,000 pounds, but the actual cost amounted to 23,000 pounds. Since the actual cost exceeded the budgeted cost, we can conclude that the company has performed worse than expected. The increase in cost might be due to various factors, such as increased production expenses, higher input costs, or inefficiencies in the production process. If 10,000 pounds of the budget cost are fixed cost, the remainder being variable, has the company performed better or worse than expected? Anyone can answer this question? Anybody is there? Okay. In this case, we have a portion of fixed cost. Fixed costs are expenses that do not change with the level of output. The remaining cost of 10,000 pounds are considered variable cost, as they vary with the level of production. To assess the performance in this scenario, we need to consider only the variable costs. The budgeted variable cost would be the total budgeted cost, £20,000 minus the fixed cost, £10,000, which gives us £10,000. Comparing this with the actual variable cost, which are £23,000. We can see that the actual costs have exceeded the budgeted variable cost. Therefore, even when considering the fixed cost, the company has still performed worse than expected, as the actual variable costs have exceeded the budget variable costs. Incremental budget. So this budgeting method is particularly suitable for stable businesses where costs are not expected to undergo significant changes. Incremental budgeting involves starting with the previous period budget or actual results and then adjusting it by adding or subtracting an incremental amount to account for inflation and other known changes. Why incremental budget? Incremental budget is often favored in situations where the business environmental is relatively stable and there is good cost control in place. By building on the previous budget, it allows organizations to focus on incremental changes rather than developing an entirely new budget from scratch. How does incremental budgeting works? To better understand incremental budgeting, so let's consider an example. Imagine a retail store that wants to create a budget for the next fiscal year. They start by examining the previous year's budget or actual results as a base. So let's say the store determines that inflation is expected to be around 3% for the upcoming year, and there will be 5% increases in wages due to labor market trends. So using incremental budgeting, the store will adjust their previous budget by adding 3% to cover inflation and an additional 5% to account for increased wages. So next is here, incremental approach to budget. AW private limited company produced two products, A and C. In the previous year, 2014, AW PLC produced 640 units of products A and 350 units of product C, incurring cost of $672,000. We know that 75% of the total cost are variable and 60% of these variable costs vary in line with the number of product A produced, with the remainder varying based on the number of product C. Incremental budget approach. AW Private Limited Company has chosen an incremental budgeting approach for preparing the budget for the year 2015. This approach involves making adjustments to the previous year's budget based on the certain factors rather than starting them scratch. So let's see how AWPLC has used this approach for product C. Variable cost analysis. To calculate the budgeted total variable cost for product C is in 2015, we need to consider the following factors. Cost increase. All cost in 2015 will be 4% higher than the average paid in 2014. This means that the variable cost of product C will also be subject to the increase. Efficiency next we will efficiency level. Expect the efficiency levels to remain unchanged from the previous years. The expected output of product C for 2015 is 340 units. Calculating the budgeting total variable cost of product C. So now let's calculate the budget total variable cost of product C using the provided information. So cost increase in 2014, the total cost incurred were 672,000 pounds. Since 75% of these costs are variable, the variable cost amount of 75% of 672,000 pounds, which is 504,000 pounds by 148. So multiply by 1.04 is equal to 523 here. Increase. So budget cost is 1.04 multiplied by 560, 599 is equal to 4. So 345 multiplied by 599 point, which is 203.674. So expected output, the expected output of product C for 3 again is 340 units. So required, as we said, zero-based budgeting. So here zero-based budgets. So here the conclusion is based on the incremental budget approach and the provided information. All the information is here. The budget total variable cost of a product C for the full year 2015 is 220 multiply but is equal to this and or to nearest 100. So this approach takes into the account the 4% cost increase from the previous year and assume the unchanged efficiency level. This expected output of 340 units for the product C is also considered in the budgeting process. 3.3 next is a zero-based budget. So zero-based budget is a method of budgeting that requires each cost elements to justify it as if the activities were being undertaken for the first time. In zero-based budget, allowances are initially set to zero and must be justified before receiving approval. So suitability of zero-based budget and its implementation process. Suitability, zero-based budget, fast-moving businesses, industries, discretionary cost such as research and development, public sector organizations such as local authorities. Zero-based process, the implementation process involves identifying activities, creations, decisions, packages, evaluating and ranking them, and allocating resources accordingly. A zero-based budget helps organizations optimize their spending, enhance accordingly accountability, and align budgets with strategic objectives. So any questions so far? Okay, so zero-based budget example of zero, the decision package was defined by Peter For, the pioneer of zero-based budget at taxes. Taxes instruments are documents that identify and describe specific activities in a way that enables senior managements to evaluate and rank them against one another and decide whether to approve or disapprove them. In simple term, a decision package helps assess activities, determine their costs, purposes, alternative methods, consequences of not doing them, and establish performance measures. Components of decisions packages like cost analysis, decision packages, cost analysis. Decision packages analyze the cost associated with an activity. So these costs can be built up from scratch, like zero-based historical record or the previous year's budget. So purpose statement of purpose of the activity identifies alternative methods of achieving the same purpose, and then consequences of not doing the activity at all or performing the activity at a different level. Then is establishment measure of performance for the activity. Prior identifies two types of packages, mutually exclusive package and incremental package. So multi-exclusive packages, these decision package present different methods of achieving the same objective. Each package outlines a distinct approach, enabling decisions making to compare and select the most suitable one. Then incremental package divides an activity into multiple levels, each with varying costs and benefits. The base package represents the minimum effort and cost required to carry out the activity. Rolling budget. What exactly is a rolling budget? Anyone can explain? Okay. Rolling budget is a type of budgeting approach that remains continuously updated by adding another accounting period, such as a month or a quarter. Once the earliest accounting period have concluded, this ongoing process ensure that the budget is always current and reflective of the organization's financial situation. You may be wondering why a rolling budget is useful and why it is more suitable. So, well, it is, always accurate, give us accurate forecast cannot be made. So one of the key advantage of rolling budget is ability to provide more accurate forecast by continuously updating the budget with the latest financial data. Businesses can make informed decisions based on real-time information. So for any area of businesses that needs tight control, rolling budgets are particularly beneficial for areas of business rather than require tight control. By maintaining an up-to-date budget, management can closely monitor expenses, revenue, and overall the financial performance. Example of rolling budget. So a company uses rolling budgets and has a sales budget as follows. Actual sales of Q1 were 123,400, 123,450. So the adverse variance is explained by competition being more intense than expected and growth being lower than anticipated. The budget committee has proposed that the revised assumptions for sales growth should be 3% per quarter for quarters 2, 3, and 4. Update the budget figures. So Q1 was 125,000 pound and 125,000 and 750, 132,030, 138,000 640, 145,000 and 572, $542,000 dollars. So activity based. So next one is activity based budget. Anybody can tell me activity based budget is? Okay. So activity based budget is a method used to calculate the full production cost per unit. It serves as an alternative to absorption costing in our fast-paced and dynamic business environment. Why activity-based budget has gained prominence and why it was developed in the first place? Traditionally, absorption cost was based on the principle that production's overheads are primarily driven by the level of production. So these assumptions held true in the past when businesses tended to manufacture only a single production or a few simple and similar productions. So in simple term, activity-based budget involves breaking down the various activities involved in our business operations and determining the cost-driven drivers for each activity. These cost drivers could be factors like machine usage, setup time, number of orders, or any other significant elements that influences costs. By implementing activity-based budget, we can achieve several benefits. First and foremost, it provides us with a more accurate picture of product cost. This enables us to make informed decisions regarding pricing, product mix, and resource allocation. Additionally, activity-based budget helps us identify non-value added activities or processes that can be streamlined or eliminated, leading to cost saving and improved efficiency. Steps in ABC. So ABC, what does it mean? Anybody can tell me? Okay. Steps in ABC, activity-based costs. So there are different steps, group productions, overheads into activities according to how they are driven. Step 2, identify cost driven for each activity. For example, what causes our activity cost to be incurred. Step 3, calculate an overhead absorption rate for each activity. Step 4 is absorb the activity cost into the product. Step 5, calculate the full production cost and or the profit or loss. So finally, let's take a look the difference between traditional absorption cost and activity-based cost is calculating the production cost per unit under the two costing methods. Traditional absorption cost assigns overhead costs based on a single cost-driven drivers such as direct labor hours, or machine hours. This approach assumes that all products consume overhead resources equally. However, in reality, different products may have varying activity levels and consumption patterns. Activity-based cost, on the other hand, accurately captures these differences by using multiple cost drivers and activity-based allocations. Here, some calculations about here exemption of activity-based budgeting. Trimake Limited makes 3 main productions using broadly the same production method and equipment for each. A conventional absorption costing system is used at present, although an activity-based costing system is being considered. Details of the 3 products or typical periods are product X, Y, and Z, 1/2 labor, 1.5 labor, or 1. So machineries, 1.5, 1, 3, then materials per units, $20, $12, or $25, and volumes, unit volumes, 750 units, 1,250 units, and 7,000. So direct labor cost, $6 per hours, and productions overhead are absorbed on a machine hour basis. So the rate for the period is $28 per machine hour, for example, the OAR, and a total to $23,375 machine, sorry, 23,375 machine hours were worked. So traditional absorption cost would give a production cost per unit as follow: machine labor, in 2012, $25, then labor is a $3, $9, and $6. So total direct cost $23, $21 for Y company, and $20 for $1 for company Z, or product Z, sorry. So production overhead at the rate of 28 per hour. So $42 for product X, 28 for product Y, and 84 for product Z. So further analysis shows the total production overheads of 654,000 pound and $500 is not entirely driven by machine hours and can be divided as follow. Cost relating to setup is 35%. Cost relating to machinery will be 20%. Cost relating to materials handling is 15%. Cost relating to inspection is 30%. So total production overhead is 100%. The following total activity volumes are associated with the production line for the period as a whole. Product A, product X, 75 setups, number of movement 12 machines, and number of inspections 150. So product Y 115, 21, and 180. Product Z is a 400, 40 number of setups, number of movement materials 87, and number of inspections 670. So its total setup is a 670, 120, number of movement of materials, and number of inspections 1,000 pounds. Advantages and disadvantages here. So provide more accurate cost per unit, leading to better pricing, decision making, and performance management. It provides better insight into when drives overhead cost, resulting in better control of cost. It recognizes that overhead costs are not all related to production and sales volumes. It can be applied to all overhead costs, not just production overheads. It can be used just as easily in serving costs as product costing. Limited benefit: if overheads are primarily volume related or a small proportion of total cost, it is impossible to allocate all overheads to specific activities. The choice of activities and cost drivers might be inappropriate. The benefit might not justify the cost since a large amount of data must be allocated. That's it for today. And here are some reference books. If you have any questions, please drop me an email at yasir@uk-versity.co.uk. So tomorrow we will discuss our final session, which is about assignment, and see you tomorrow at 10 o'clock. And have a good day, guys. Bye for now.